All right.
There we are.
I think we're live. Okay, good morning, everyone. Thanks so much for joining us. Whether you're tuning in live or if you're watching the replay after the fact, we're appreciative that you're taking the time to chat with us today. This is our very first LinkedIn Live, so this is a very exciting day for us. So I hope everything sounds okay. But today we're going to be talking specifically to business owners, and we're going to talk about how they can qualify for a mortgage with their income, with self-employment income that's not exactly the standard W-2 income from an employer. There's some complications that come with being self-employed and proving your income. So we're going to be chatting about that today. We'll be talking for about 20 minutes, and then we'll leave time for questions at the end. But feel free to pop any questions in the comments, and I'll try to keep an eye on those as we go. My name is Rachel Burns. I'm a certified financial planner and certified divorce financial analyst. I'm based in Folsom, California, and I'm joined by a very special guest, Bahadar Takhar, which I just realized I've been saying his name wrong. I've known him for a while now. So Bobby is a mortgage loan officer with Big Valley Mortgage. And he's not just any mortgage loan officer. He's a very special mortgage loan officer. So Bobby specializes in helping business owners qualify for mortgages. So he is an expert on this exact topic. And aside from that, another really amazing thing about Bobby is Bobby has his own charitable organization that he started. It's called Mortgages and Miracles. And Bobby, I'm going to have you kind of talk about the story behind the organization because it's such a powerful story.
Absolutely. Thank you very much, Rachel, for number one, bringing me on. Thank you very much for the awesome introduction. And if you all are watching the video, I have to make a quick comment. If you look behind me, there's going to be like a little nail on the wall right there. There used to be a picture up there that I didn't really want on the video. So I took it off and I can see that nail on the wall. So if you see me like this and there's something sticking out of my head, that's the nail back there. So want to throw that out there to begin with. But yeah, Rachel, thank you very much. And everybody that's joined in this presentation or watching later, really appreciate you taking the time out of your busy day to join Rachel and I. Mortgages and Miracles. I came back into the lending world for a purpose. I was a lender many, many years ago. And I came back in to really originate mortgage loans and then donate a significant portion of my salary from this role to our local children's hospital at UC Davis through my relationship with Children's Miracle Network, and then also at Shriners Hospital here in Sacramento, California as well. It's a long story. I won't take up too much time in this presentation, but our son in 2018 became gravely ill and just came down with a very, very horrific syndrome that my wife and I and daughter and him, we had no idea what was going on. And so he was hospitalized at Shriners Hospital here in Sacramento, California. And he was cared for day and night by staff, nurses, respiratory therapists, surgeons, ophthalmologists, therapists, 24/7 from UC Davis Children's Hospital and UC Davis Health across the street from our Shriners here in Sacramento. And we weren't sure of the outcome of what would happen to him, but he survived, and that's the number one thing. And during our time there, we went through a lot as a family, and at that point, there was one night I was sitting in his ICU room and just looking out the window. It was pouring rain, and there's a helicopter flying in at the UC Davis Hospital across the street, and I'm like, wow, there's somebody else coming in. This is not good. So at that point, I decided, whatever the outcome is with our son, I want to give back, and I'm going to continue to give back for as long as I can, as long as I'm alive, and hopefully create a legacy for our family to do so, because there's going to be so many families that are going to be in a situation that we were in. It's not fun. It's very, very stressful for the patient as well as the families and the caregivers that endure that. And so, once he was discharged, I thought of different ways of giving back to Shriners and again, the hospital at UC Davis Children's Health. And we would donate toys here and there. We would, donate dinners here and there, but just I felt like we weren't making an impact. And I wanted to make an everlasting impact at really every child that is walking in or ambulanced into Shriners or to the UC Davis Children's Hospital. I want to make them better. And I want to do whatever I can within my capacity to help these hospitals even further give better care, better services in many different areas. And so, over 3 long years, I figured, how am I going to do this? What am I going to do? And in mortgage lending, I was a mortgage lender many, many years ago. And said, wait a minute, I loved the industry. I loved what I did. I can go back into mortgage lending. I can make good money. And if you make good money, you can donate good money. And so that's where the Mortgage Miracles program came from, is that I partnered with Children's Miracle Network here in Sacramento. And so here we have mortgages and miracles. And so then a big portion of my salary, again, on every closed loan gets donated right back to both of these institutions. That's where Mortgage Miracles came from. And here we are.
Bobby, thank you so much for sharing that story. It gives me goosebumps every time I hear it. And I think people appreciate that they can support causes that they care about just with kind of everyday financial transactions. Not that buying a home is an everyday thing, but you can use your dollars in a way that's aligned with your values, even when it comes to buying a home, which I think is really amazing. And I think that that's something that people are a lot more aware of now. And so I think this is like the best example of aligning your money with your values. So thank you so much for sharing that. So let's go ahead and dive in. I'm going to hand it over to you.
Perfect. So what I want to talk about today is business owners, entrepreneurs, and those that are self-employed, right? And so, a lot of times we think, well, it's all the same, but it's a little bit different. So if you have a self-employed individual, typically they're working for themselves. Typically they may be working out of their home, and so their tax returns are set up a certain way. A lot of times they run their, all their business money through their personal account. So you have self-employed individuals. Then you have business owners. Business owners are a little bit different. They manage other people. They run a business. They have other employees, and they might be set up as an LLC or an S corporation, or there could be many, many different ways that they could have their business set up. And so when they file their tax returns, it could be a little bit different as well. And then entrepreneurs, heck, you all are out there just going out and getting it. I mean, that's you're coming up with a new idea. Perhaps you're seeking capital from investors, and you're building something. And you could be a solo entrepreneur. You could be an entrepreneur that's maybe hired some staff. So the way your tax returns are going to be constructed might be a little bit different as well. So first off, we just distinguish the difference between who a self-employed person is, a business owner is, and then who an entrepreneur is, and their taxability and how they report taxes. So when we look at the housing market right now, and I'm not going to go through a housing market update or outlook. I mean, there's so many out there that you can read, and everybody's going to have a different opinion. But the bottom line is that the housing market has been very strong in California, and especially our Sacramento area. Simple economics: when you have low supply and equal or high demand, the values tend to be where they're at. So what's happening in this environment is that our self-employed borrowers, when we look at mortgage loans, there's really 3 different ways that you can go. There's more than 3, but the 3 most popular ones are: you can go into a FHA type of a loan, you can go into a conforming loan, or you can go into a jumbo or a non-qualified mortgage loan as well. So I was planning on sharing some slides, but I'll just talk right through it just for the sake of time. It'll make it easier. I can fumble around with my keyboard. So when you are looking to buy your home, what lenders look for in terms of your income is on your tax returns, what is your net taxable income? And if you're a business owner, you know that your revenues and what you bring in through the course of the year is going to be a lot different than what you show on your tax returns for Uncle Sam. And so that's where sometimes the complications come in, is that, I'll use an example. If you have, let's say, a company here that they do window installations, right, for homes, and they generate, let's say, $480,000 in revenue through the course of the year. But when they file their taxes after deductions and everything that's allowable to them, they're showing a net income of $120,000 a year. As lenders, we're going to look at that $120,000. And then as a lender, then we're going to say, okay, well, $120,000, let's say I'll just use a 1-year example divided by 12, is $10,000 a month of income that we can use. From there, we can only use 43% of that typically for your debt ratios. So if you're doing an FHA loan or a conforming loan, what that means in plain English is that you can have your monthly payments up to about $4,300 a month. It's kind of hard in this day and age to buy a home with the prices the way they are with that type of income, let alone the dream home that you're looking for, in El Dorado Hills or Folsom or Roseville, Rockland or Elk Grove or wherever it might be in California, San Diego, Calabasas. So then that creates a complication. So how do business owners then get that dream home that they're looking for? And so if you're looking for, and I'll just use for an example, $2 million home. And getting a home for $2 million right now in California, it's prices have gone up, right? So you're not going to get that big jolly mansion for $2 million anymore, but you'll get a very, very good sized home for $2 million. But with your income qualifications on the tax returns, that's not going to work unless you have a substantial down payment. So what we do is that for that situation, we go what's called the non-QM side or a non-qualified mortgage side. And so a lot of times there's a myth out there, Rachel, and everybody listening that, oh my goodness, non-QM, no way, dude, we're not going there. Isn't that the stuff that created that big mess back in 07, 08? No, thank you. Wrong, very wrong, far from the truth. There was a lot of regulation. There's a lot that went on in 2007, 2008, 2009, coming out of that great financial crisis to really try to do everything that legislation can do, everything that lenders can do, everything banks can do that do lending to not get in that same situation again. Can that ever happen again? I mean, anything can happen, right? But there's been a lot of different guidelines. There's been a lot of backstops that have been put in place since then, where it's not as easy as saying, hey, just write down whatever income you want on your loan application. Write down whatever you have in your bank account. We'll take it and we'll get you a loan and we'll even do interest only and negative amortization. And this will be great. You can buy that $500,000 house that you really can't afford. That's not the case anymore. So what I'm going to talk about is I'm going to talk about our non-qualified mortgage department. I'm going to talk about a specific loan product that is geared towards business owners, self-employed individuals, and entrepreneurs. And that's really, the way to go if that's what you're looking to accomplish is getting that dream home. Okay. I'm going to check in there, Rachel. Any questions for me at this point, or have any questions popped up?
No, not yet.
Okay. So what we're going to look at is when we look at qualifications, again, when we're looking at income, we have various types of loan programs on a non-qualified mortgage side. The most popular one right now, I'd say, is what's called the bank statement. And what that does is that we're going to look at your bank statements and look at your revenue stream. So you can either A, provide 12 months of bank statements or 24 months of bank statements. And it's very, very simple. The first question you would get is, well, why should I do 24 if I can just give you 12, right? It's kind of like, if you're applying for college and you had one great semester, you're not going to send that transcript to the college. They're going to look at something a little bit longer, right? You're going to look at your transcripts from all your work. And so the longer you go on your bank statements, the better it is for qualifications, the easier it is for qualifications. Sometimes down payment requirements are a little bit better. Your credit score requirements are a little bit better. So that's different why you do 12 or 24. But those are your two options, okay? So from there, what we're going to do is we're going to take the revenues. We're going to look at every single month and what's been deposited into the bank. And then we're going to subtract out any kind of, NSF fees or anything that maybe might not be revenue for that particular business. We're going to subtract out any, out of the world large deposits that came in. Let's say your business had a loss. Maybe there was a small fire, and part of your building, had to get renovated. So the insurance company sent you a big check. So we're going to take out, those kinds of deposits. And then from there, we're going to take all your income. We're going to add every single month up for 24 months. And then we're going to have a dollar amount. So going from the earlier example, now if you're generating $480,000 in revenue, and that's what we see on the bank statements, we're going to take $480,000, and then we're going to divide that by 24 months. And it's going to give you, and I can do my math in my head, but I'm going to do it on my calculator right now because I don't want to be wrong. It'll give you $20,000 a month of usable income. So that's a lot different than what we're looking for on the tax returns. Now from there, we're going to look at divided by, yep. So from there, we're going to look at the fact that just because we're using your revenue stream, right? Obviously you have expenses. Obviously you have, overhead, you have labor, you have car expenses, meal expenses. So there's expenses involved. So what we do is we take that monthly income that we've come up with and we cut that in half. So from there, that's going to be our qualifying income, which is a lot higher than the income that you're showing on your tax returns. So I'm not going to go deeper into, calculations and that type of thing, but I think for this presentation, as an overview, that's how this type of a loan program works. So what's going to happen now is since your income to qualify is a lot higher, your debt to income ratios are going to allow you to have a larger home payment. When you have a larger home payment, you can buy that larger dream home that you're looking for. That and all of all the ins and outs of the program is how the program works. I'm going to stop there.
Bobby, I have a question for you.
And I'll ask, yeah, absolutely.
Oh, perfect. So I'm in a service-based business, for example. I'm using myself as an example. So I'm self-employed. I'm in a service-based business. My overhead is very low compared to someone who maybe operates a grocery store and has very high, they're selling products, they have inventory, that, very high overhead. How does that work with two very different types of businesses and two very different profitability numbers?
That's a real good question. And that's actually probably one of the questions we get a lot, because now, again, I'll use your example, or I'll use an example of, somebody who's, running a restaurant, right? Obviously their expenses are going to be very, very high as compared to somebody like in your situation. So what we do is if I go back a little bit, take one step back, and when I mentioned that we're going to take your income that we've calculated out of your bank statements, right? Then we're going to right away cut off half of that as your expenses. Now, if you're working from home, you don't have a lot of high overhead and have a lot of expenses, then what we can do is we can have your CPA or a tax preparer provide us a letter saying, look, here's her situation. She doesn't have a lot of overhead. Her overhead is probably no more than, 20%. So with that, then we can say, instead of using a 50% ratio where we cut your income in half to use, we might use 80% of your income then. And so then that allows us to use a higher income level, because obviously you're not going to have, that high overhead as compared to maybe a restaurant owner or something on those lines. And so from there, now on the flip side, if you are, let's say, a restaurant owner, you have a lot of overhead, or you're not working from your home office. You do have, office and building and rent and everything else. Then depending on the industry, and this is where it's very, very specialized and it's very, very individualized in terms of, your unique scenario, because every loan is different that way, then we might only be able to use 30% of what we've calculated on those 24 months of income. So each industry is going to be different. Each situation is going to be different. And that's when we say, hey, look, we can't just say, hey, Bobby, what's the rate? Hey, Bobby, can I get approved for this? No, we really, really need to get a full-on complete loan application with everything that I need to know. And then from there, then we can say, okay, how are we going to best maximize your potential and get you the home that you're looking for.
So
yeah, there's different ways.
You mentioned, looking at the last 24 months versus the last 12 months. So if we think about what's happened in the last 24 months, quite a bit's happened in the last 24 months. So some businesses were obviously impacted by COVID and everything much, much more than others. So is that kind of blip on their history going to harm them when it comes to qualifying?
It may or may not. Again, depending on the industry, depending on the type of business. So again, each situation is going to be unique. I would say there's a lot of, you can look at, the wedding industry, right? Who would think that the wedding industry would have any issues? We're always going to get married. People are always going to get married. But they even shut down, right? So even businesses there in the wedding industry had issues. Obviously, restaurants and other public areas, had to deal with shutdown. So if you're in that situation, then number one, we can look at your 12 months bank statements instead of going back to 24 months. So what we're going to show there is and we're hoping that you've recovered from during the shutdown period. So if you had a business that did great during that environment, because there's some businesses that really did, then yeah, it's not going to really affect you. We can still use the 24 months of bank statements. Now, again, if you were maybe a repair shop and people weren't driving to work, they weren't getting their cars fixed, and so you weren't having any revenue during the pandemic, right? So if that's the case, what we're going to look for is, again, we're going to look at then your 12-month bank statements, but then we also are going to look at is, okay, did your business recover? Are you heading in the right direction? So there's a lot of commentary. There's a lot of data points we're going to look at to make sure that yes, they were affected during the COVID environment. They've come out of the COVID environment and they're back to normal and they're progressing. So we're going to look at that as well. So it's kind of like I mentioned earlier, about what happened in 07, 08 and non-qualified. Oh my God, we're not going there. Those kind of questions weren't being asked. And so now it's very, very detailed in terms of who gets qualified for these types of programs, and which is a good thing. So yeah, you could be impacted or you could not be impacted depending on your unique situation.
Great.
Questions? Anything else pop up on the chat or anything else that you had in mind?
Nothing on the chat. I work with a lot of divorcees. I work primarily with newly single women. So I run into clients who co-owned a small business with their spouse, and then all of a sudden they're not going to be co-owning it anymore. And, with the spouse that ends up keeping the business, how does that look for them if they are trying to qualify, but their history is the income from a joint business that they were operating? It gets a little tricky when they're divorcing. So how does that work for them?
It does get extremely tricky. And, if you're in a divorce situation, obviously you have a lot of things to worry about, right? At that time, there's just a lot of moving parts. And I think that's, where your expertise comes in as well to help them really walk through the financial side of things. So again, each individual situation is going to be different. So, what I would say in that situation is that, number one, we would look at if the divorce is finalized. We would look at the divorce decree and really, how is everything split? All right. So if the spouse is now taken over 100% of the business, then we will look at the last 12 months or the 24 months of the bank statements of that business. And then now if the new business owner, the spouse is going to be 100% owner, then that spouse can still qualify as long as we have other supporting documentation, from the divorcing spouse. We would probably need something in writing from that individual. Here's what our business was. It's going to continue to flow, and so we would need that documentation. But sometimes in a divorce situation, they might not want to do that, right? They might not want to write a letter such as that and say, I don't care, I'm done with it. And so it could be possible. So I wouldn't, be discouraged in that sense if you're in that situation. But again, that's something we would talk on one-on-one and making sure that we understand your unique situation And then we would come back and say, okay, here's what we can do, or here's a documentation that we need from you to see if we can make this happen for you. But it does get tricky, but it has been done and it can be done.
Great.
So there's, again, I know we only had about 30 minutes, so I wanted to go really high level. There's a lot of, criteria in terms of credit score requirements, down payment requirements, how long you have to be in business. I mean, you have to be in business for at least 2 years to qualify for such a program. And so what I would say is just give me a call, contact me, email me, head out to my website, or chat, link with me through LinkedIn, and we can chat through there. My role here is to understand, number one, your unique situation, and from there, see, okay, do we have a solution? And then how can we accomplish that solution? What kind of interest rates you're looking at? Actually, we didn't even touch on interest rates, and I'll touch on that real quick as well, because we get that question all the time. Bobby, that's great. You have this awesome program, but I'm going to pay like ridiculous interest rates. It's not going to make sense anyways, right? So that is also another myth. Back many years ago, there were certain lenders that would provide such loans, and their interest rates were, out of this world. They were, 2, 3, 4% higher than your regular conforming rate. Their points were, you had to pay a ton of points and fees to get in. That's really not the case anymore. The interest rates are very, very competitive. Obviously, they're going to be a little bit higher than your typical conforming loan, or your typical conforming or FHA loan, or your full doc, let's say jumbo loan, where you provide all your tax returns and everything. So the interest rates are going to be a little bit higher, but not to the point where you're like, dude, I just wasted 30 minutes on this presentation. This is ridiculous. That doesn't make any sense for us. No, it's very, very affordable. It's very, very feasible in this environment.
So Bobby, I had not heard about this solution until I talked to you, and I'm just curious, is this something that is offered at the big banks, or is this seems like it's a kind of unusual solution, right?
It is. So what we do is it's a unique solution, right? So it's not talked about very often. Since I have a focus, right, and I have a niche that I work with, this is what I want to talk about. And so a lot of lenders typically don't talk about it as much. When it comes to big banks, or regional banks or credit unions, they're phenomenal at what they do, number one. So if you're looking for a conforming loan, you're looking for an FHA loan, first-time homebuyer loans, refinances, which we can do on this bank statement loan program as well, they do a phenomenal job. Their rates are really good. Their service obviously is hopefully going to be really good as well. But what they do is, when it comes to large, big banks, they're not going to delve too much into these types of specialized loans. A lot of local credit unions are not going to have an entire division that they're going to create and specialize in certain types of loans, because there's, in the non-QM market, or what we call non-qualified mortgage, there's a lot of different loan programs out there in which we can even have further chats on different sessions. Bank statement programs are just one of those programs. There's if you're an investor and you don't want to show any income and you want to buy an investment property, there's DSCR loans. There's if you're a retiree, or you're retired, or you're a high net worth individual, you have a ton of assets, but maybe you're retired and your income has gone down. You're collecting Social Security and a pension. So there are loan programs out there as well that will allow you to buy a house using perhaps your assets, where we don't attach ourselves to your assets or anything like that. But there are programs out there that will allow you to buy your home that may not be available through a local bank. So I would say, if you like your loan officer or your bank, your big bank or your credit union or your local bank, talk to them about it. Talk to them about it. See if they offer something like that. If they do, that's awesome. If they don't, then, I'd be happy to help in those lines.
Awesome. Well, I think this is really helpful information. It's something I don't think is common knowledge. I think there's a lot of misconceptions about lending, and I feel like there's just more business owners these days. A lot of people, as part of the whole Great Resignation, left their career and went out on their own, myself included. And a lot of people, I think, made that leap not fully understanding the impact that it has on other parts of their financial life, and particularly when it comes to qualifying for a loan. And they're probably like, oh, how's that going to work? So I think this is extremely timely information. And so I hope that this is helpful and helps kind of give you some direction when you're looking to buy your dream home with your self-employment income.
Absolutely.
Well, thank you so much, Bobby. This was so informative. Thank you for your time. And thanks to anyone who's tuning in or who's going to watch the replay. And if anyone has any questions on the subject, Bobby is obviously the person to contact. So Bobby, what's the best way that people can get a hold of you?
Email. So I would say if you have a pen and paper handy or your notepad, this is probably the best time to use it. First, my email. It's Bobby, Bobby, .Takhar, that's Takhar, at apmortgage.com. So again, I'm a loan officer with Big Valley Mortgage here in Elk Grove and Roseville, California. And but we are also American Pacific Mortgage. So that's why the email will say AP Mortgage. So it's Bobby.Takhar at apmortgage.com. My direct line on my mobile, you can call my cell number if you like. It's 916-525-5670. It's 916-525-5670. Hopefully that doesn't change 20 years later when everybody's still watching this video. And then you can also visit my website, www.mortgagesandmiracles.org.
Awesome. Thank you so much. And if anyone wants to reach out to me, I'm a certified financial planner, certified divorce financial analyst. My website, actually, if you go to, so we're on LinkedIn Live. If you look at my LinkedIn profile, it has all of my contact information, all my social media links. That's a really good way to keep in touch. My website is trueworthfp.com, and you can get more information there. So thanks everyone so much for joining us, and have a great rest of your day. Thanks.
I appreciate it. Thank you, everybody. Have a good day.